You guys are here, I'm assuming, because you want to be traders. And a trader has a very specific function in the market and a way that they are able to be profitable. And that is by making a spread between buyers and sellers or sellers and buyers. You are a middleman. And the better the middleman you are, the better you're going to do. So it is your entire purpose here is to learn the role of the trader, the middleman, and understand when market conditions are favorable, where you can insert yourself as a middleman and take a profit. That's your entire job. So we're not here to buy and hold forever. We do like to do some longer term stuff, but I'm talking about like lifetime investments of, holding Coca-Cola. There's no, everyone here I think wants to be a little more aggressive than that because they like the idea of timing the market. So, um, anyway, that is what we're here to do. We're here to teach you guys how to understand how money is transferred, the emotions that are at play that cause the ups and the downs in the market, and to position yourself as unemotionally as possible in between everybody else. Okay. And the first rule in that is understanding that the markets are driven, the action in the market is driven by pain and pleasure. Yes, fear and greed float on top of that. But the root for human behavior is pain and pleasure. And simply put, when people are losing money or getting profits taken away from them that they never booked, same thing. When they are watching the P&L clock backwards against them, it hurts. They don't like it. And that causes action. That causes them to press the button and get out. Versus when people are in pleasure and things are going for them, everybody thinks they're wondering how far can it go? And it causes less and less action. Okay. Your job as a trader is to first of all understand that concept. This is why it's so easy to lose. It is so easy to lose because you naturally want to stop the bleeding and the market will put you at a loss. It's almost just a matter of time. If you click in anywhere, buy, sell, anything, doesn't matter. You buy, sell at any given time in the market, chances are it will range out at least for a little bit at that price, and you will see a negative at some point in the life cycle of that trade. The key is having the mental awareness to understand that you will feel pain and you will be uncomfortable when it goes against you because now you're thinking, how far is it going to go? Was I wrong? All the doubts start to creep in, and it's natural. And that causes you to actually say, I'm going to close a trade. And when you do that, when you fall into that closed trade at a loss is a booked loss. And you string enough of those together, you're losing. It's actually very simple. So when you understand that, all the market framework that ATS draws, all the lines are designed from that one concept. This expansion line, it's the center of belief, it's a neutral. Your buy liquidity lines and your sell liquidity lines are ultimate breaking point zones based off of how the market unravels from a neutral area. And that's what we ultimately call the master pattern. It's contraction, it expands, multi-leg expansion, up, down, taking out highs and lows, and eventually it moves to higher or lower prices and starts over and over and over again. So everything that we're doing here starts with the mindset of understanding why traders lose. And that way you guys with ATS can stand back and you can look at the players on the field. You not only know that you're on the correct playing field, but you can actually see where the neutral beliefs were created, where the extreme beliefs have been created, who's in pain, who's in pleasure, and where are they going to break. It gives you a view of that playing field. And you guys have the best possible place to be, though it's not easy. Eventually, you have to enter the game yourself. But you are able to look at it from the top down and see who's doing what and where you could jump in as a trader and fill your role as a trader to make a spread between the buyers and sellers. And that's typically riding the market from pain point to pain point. Buyers are in pain, you buy. And when sellers are in pain, when buyers are in pain, then you buy. And when sellers are starting to get in pain, you sell. And those are the ends of the master pattern cycle. That is the expansion, right? Now, that's not enough. It's not enough because we don't want to be open to trading it both ways. We want to trade it in one singular direction in the higher time frame flow. And why is that? And it's simply put, the higher time frame flow of money is where the banks are able to make a return on the money that they have. This is why the macro fundamentals work overall. The monthly charts, even the higher charts that we're not looking at, but let's just go up to the monthly. The banks they cannot make a return on billions of dollars in a 5-minute trade. Now they can make market making spread. They have other revenue sources that they chop those things up. But we're talking about their bets, where they build into a position and how they exit the position. It takes time. So when we follow the higher time frames, the higher time frame you go up, the more you're going to be in tune with the biggest money that's being made in the market. The biggest money that's made in the market is made over months and years in those macroeconomic directions driven by the fundamentals. That's where the biggest money is made. So the more you get up in tune with those, the more you're going to be understanding where the bank's ultimately driving this price because they need time to not only accumulate, but they need time to exit. It only makes sense. You're moving a lot of shares, you're moving a lot of currency, you're moving a lot of anything. It takes time. They're not just going 100 billion in all at once. They don't do that. It's a slow accumulation, a slow distribution. And the only way they're going to start that process is if they have a multi-week, multi-month, multi-year forecast that they're going to have time to do that potentially over and over again and not rattle the market where it causes them to kind of show their hand. So we put these things together. We have multi-time frame momentum, right? The bank's direction on the higher time frames. And then we put together understanding the beliefs and the breaking points of the lower time frame, the lower time frame traders. And with those two things, we have our methodology. So that being said, let's go into what is going on Eurodollar. So I'm going to pull up the daily chart here because I know a lot of you guys are trading the daily into the 30. Now, I can't stress this enough. The ATS methodology is not bouncing off lines. That's what it looks like, but there is logic here. And like I said, when I started these webinars are designed to get you to understand the why. Why does it do what it does? Because if you understand the real reason why, you can create an objective strategy that when you lose, you have information. If X isn't happening, then Y must be happening, right? And if Y isn't happening, then Z is happening. It's a process of elimination when you look for these things to line up, okay? So let's walk through this trade right here. What happened? Right here. We had a contraction. The market dipped down below, broke out of that. The moment it goes out of that box, it's in phase what? Phase 2, expansion, right? As it expands, it comes back across the box. We have that minimum guaranteed volatility. It's 100% going to happen. It comes across the box, trades up, hits our order block projection. This is fancy, newer addition to ATS order blocks. It's just an anomaly that happens within the expansion range, but is not part of the core framework. Core framework, expansion line, liquidity lines, boxes. Okay. We have add-ons, but you can see that the add-ons are helpful. Comes up, trades up to the order block projection. Okay. Comes back down to what we call fair market value, because on this candle, we get a expansion line. Okay. Let's talk through what's happened here and also what's happening here. At this point, if you see where this box was formed, We look at the higher time frame on the daily. That's this candle right here. We see that the inefficiencies that are happening over and over and over again are to the downside. We know that because the ATS trend is telling us. It's not just a simple average-based, settings-based trend following indicator. It is following the gaps left in the market. And it's not just the 3 candle fair value gap either. It is it follows what's called group separation as well, which is not really talked about a whole lot. But there are inefficiencies in groups of candles that you can also map as well. So it looks for all of it. And the minute that a down efficiency is shown, it's going to catch on to that. That's where we are right here on this dot. Okay, what we're expecting is that if a new down efficiency has started, it could be followed by a series of more down efficiencies. That's what makes the line follow it. If there was an up efficiency, you would see a directional change. So what we're looking for is a cascading effect of down inefficiencies at this point until it goes up. That being said, those down inefficiencies on the daily are going to be made up of the 3 market phases on the lower time frames. They have to be. So what does that mean? What that means is that when we get a box right here, the moment we get that box, we have a predefined expectation that the 3rd market phase, the trend phase, will be in the direction of the higher time frame. And if we're looking at the daily, then on a day-by-day basis, we're expecting that most of the trend phases on the master pattern will result in a traveling to the downside. Okay. We have that predefined expectation the moment this box appears on the screen. Now, when it starts expanding, we know that this is a value point that's been established. How do we know that? It's not rocket science. On this time frame, the market has come down into, call it a wedge pattern. Fine. It's come into a neutral point, right? At that neutral point, what are you thinking? You're watching. You might have some bias, and this is probably not the best to ask this audience because everyone here follows this methodology, but in general, what are you thinking? You're thinking, I wonder if this is over. I wonder if it's in a bounce. Maybe it'll go down. I don't know. It's confusion. You don't know what's going to happen because it's starting to shrink. Everybody, because we can't tell the future for certain, everyone's thinking the same thing. So what ends up happening is that no one really wants to buy and no one really wants to sell en masse. So what that creates is it creates a fair market value. It's an agreed upon price for the moment. That's the only way the price stays there and contracts. If it weren't agreed upon, it would still be trending. So we have an agreed upon price, right? Again, it cannot stay there if it were not agreed upon. Okay. So everything comes into a point. Now, what's everyone waiting for at that point? They are waiting for the market to do something so that they can break out trade, right? So as the market leaves that contraction point, which we mark as the top and bottom of the box, that's where the game starts again. Now people are starting to be like, okay, is it breaking out? Is it breaking out to the short side? Maybe they go short. Is it breaking? Okay, no, it's definitely a reversal. Then they go long. Oh no, then it goes short. Okay. What makes us different than everyone else is that we are only going to play this box one way and one way only. And that's to the downside. And why is that? It's because the higher time frame money, the higher up you go, the more stable and the more money to actually be made from the bank's perspective. So the higher time frame based on the daily, the profits over the next few days are likely to be to the downside. It won't go forever, but that's where the probability is. So we know that we are only looking to sell this market. And if we want to sell this market, what do we need to do to make the best chance of us getting to make a profit? As a middleman, as a trader, not as a long-term investor, as a trader, what do we need to have? What do we need to be doing to be a good trader? Well, two things. We need to accumulate inventory. That's number one. And when you guys open up a store or anything else and you want to sell products, do you guys try to find the highest price supplier or the lowest price supplier? In other words, do you want to pay the least amount for good quality goods that you know you could sell or the highest? You want to pay the least amount because that means that when your future customers come in, you'll make the most amount of money, correct? Okay. So, how we do that, the equivalent of that is understanding fair market value and whether market is overvalued or undervalued. And that's pretty self-explanatory. Here's value. If this candle's right here, is that over a value or undervalue? It's overvalue, right? This candle right here, here's last value. Is this candle undervalued or is this candle overvalued? It's undervalued. Very simple. Okay. Now, you guys that have come into this new, you're like, oh, I just buy above this line, I sell above this line. I'm explaining to you why right now. Okay. What is happening the moment this happens and you guys get above value is that traders that are looking at the 30-minute chart that have a shorter time horizon for their trading idea. It's based on the 30-minute chart and even on some of the time frames below. But anything around this general time frame, they are thinking there's some subset of traders in there that are thinking that the market is done trending, that they're going to buy right here. Okay. Those traders, we know they come in when they come over this point. Why is that? Because they were neutral right here. Anybody that was looking at a 30-minute chart, they were neutral. They didn't know what was going to happen. When this started going down, they thought it might be going down. Now that it's going above this, it's tipping above and below this equilibrium point. So when it goes above, they start thinking, I think it is going long. Those are the traders that we want to get in the middle of. Why? Because we have different knowledge. We have knowledge that the higher timeframes are driving price down because of this simple fact. Inefficiencies are being over and over again being put to the downside. This is stronger. This trend is not going to end until a minimum of the daily gives up and the higher timeframes, because even the weekly and the monthly are down now, right? So we know that's only a matter of time before this pump fails. So the traders that are getting in from a very logical perspective, the ones that are just looking at the short time frame, they're focused in right now on 30-minute, they're willing to buy, and we are willing to sell to them. Because now here comes the second part. That was number one. We want to sell to these traders that are coming up because we're able to get discount inventory, right? So that's number one of what we need to do as a trader is get good pricing on inventory. We know that we are selling something that is overvalued. That means we know we have essentially traders that are suckers, that aren't looking at the big picture that we want to trade with. We know that the dumb money is starting to come in to some degree. So we are getting good inventory. Now, the second thing that we need to do as a trader is we need to make sure that we haven't opened up our store in the middle of a desert where there's no customers. We got the inventory, but we need to make sure that this thing's going somewhere. Okay. This is where energy comes into the market. We want to trade stuff that has a lot of energy flow, a lot of willing participants. Okay. But how we're going to forecast that we didn't just buy a bunch of inventory or accumulate for nothing is we are also looking at the higher time frame to deliver our customers. We got the inventory, we got the stuff. Now we just need to sell the stuff, right? Or buy back if we're shorting. But you guys follow me. Okay. We got our stuff. Now we need customers. So it is now a waiting game because we are counting on this higher time frame to deliver our customers. And those customers, the way we are going to make a spread is above and below fair market value. We know that if we sell something above value, we get the stuff, get the inventory, that we want to sell it below value. Why is that? Because not only do we accumulated from dumb money up here, but what are the same people that bought right here that we took the inventory from? What are they going to do when we break out after we hit value? They're going to do it again. They're going to sell. And this one, they might have been okay because at least they're doing it in the prevailing trend. But we don't really care. We're looking to make a spread above value to below value. That is how we know that we are positioning ourselves in the best possible way with the highest probability to do what a trader is supposed to do, which is expertly accumulate inventory and sell it to someone else and make a profit in the middle. Our profit in the middle is this traversing back and forth based off of fair market value. As you can see, everything here is based on the way the markets work. And the basic strategy of accumulating above and below value, as you can see, is based off of very solid trading practices of understanding who's doing what, understanding where the ultimate probability is and the ultimate flow of money is, and positioning yourself expertly in the middle of that. So as the market comes down through value and you get this big gap down here, you could either take it at the order block projection, or you can, at this point, this is where I don't have a great answer for you. Everyone says, well, how long do I ride it? You know what? I'm trying to get you from here to value. If I could get you in the money in this space, then the other part, the third part that's critical to this, because what I said right now is not enough. Yes, it's a very, very solid way to enter the market, but it's not enough because guess what? You're going to get these entries wrong. Everybody does. The ultimate way to almost guarantee that you will be profitable immediately is to be willing to do what I just said with expert discipline, expert level discipline. Do not break the fundamental rules, but do it at a much smaller position size than you probably think is exciting. Why is that? It is so that not only are you positioned in the best possible way based off of other people likely to lose, right? The accumulation of inventory. But remember, eventually you have to join the game, right? You guys have to get involved. The moment you put a trade in, you are now involved. The way that you're going to stay involved is to make sure that you respect and you account for your own pain threshold. And the way that you do that is that you don't hold a knife up to your own throat with a huge position size. It's not fun. It's not that exciting. I know that super high leverage trades and everyone's trying to find, well, if I have a 3-pip stop and a 50-pip upside, then I'm going to crush it. No, you're not. It's not working out. You know it's not. You're going to get it continually hits your stops. You might have a couple good runs, but you know as well as I know that when you leverage up, you will wipe away 2, 3, 4 months of little tiny progress with one freak out. And it might be you mentally overlook something and get spun out, whatever it is, black swan event, whatever. What we're talking about here is understanding the discipline, understanding the true nature of the markets, how to accumulate discounted inventory, and how and when to distribute that or take your profit based off of a repeatable cycle, a repeatable process. And then with all that knowledge that you think like, oh, well, with this knowledge, I could pinpoint it, but forget it. We're still going to tailor way down so that we can survive forever. That's it. That is the golden strategy. You combine all those things. If you can't survive in this market and make progress every month, every year, I mean, you're not doing what I just said then. But you have to greatly tailor your expectations as far as what is sold out there. It's not that way. Everything the way this industry works and the way that the banks make their money is on long time horizons. That's where they make their big monies or big bets. They make it on long time horizons, and they do it with other people's money. The government's money. Look at 2008. They took out all those bets and lost, and they still got bailed out. Now, you could either continue to go along with the narrative that is sold online and continue to feel like I'm a loser because I don't have a Bentley and a jet, or you come down to the realization of how the long-term people stay in this game, long term. Come to grips with that. Okay, well, I'm not going to be a bazillionaire overnight, because you can't with small positions. You can have an extremely high win rate. You look at Mark Wilson, his book, Crude Rebellion. I did an interview with him. If you guys haven't got the book, you should get it. Insanely high win rate, but small positions. But Mark's going to stay in here forever. People like Mark are never going to lose. Mark will look back at 10 years and still be here and still be growing every year. Everyone else that was like, that's too boring, that's too slow, has blown up 50 times. Maybe had a lot of fun. Casinos are fun too. But that's the reality, guys. That's what the banks are doing. That's how they survive. They make sure they have a lot of assets under management, and their goal is to raise more money, keep that money. And do you think that they're worried like, shoot, if I don't make 500% on my money, or if I don't make 1,000%, I can't pay my mortgage? No. Getting their fees. If you manage $100 billion, then, your management fee as the hedge fund manager is 10 million, or 20 million, whatever it ends up being. Can you live a decent life with 10, 20 million? Yeah. Yeah. All they care about is making sure that they provide just enough return to keep that money here instead of it going somewhere else. And they live their life. So you could do whatever you want. But the secret, in my opinion, to staying here, number one, stop losing money, but can keep existing. And when you keep existing and you protect your account by not doing stupid stuff and not trading too much, guess what? You get some markets like we're in right now. You get some big trending markets and you're there to see it. And you can go a little bit more aggressive and you can capture that move, and you could do it with relatively low stress. Because you're surviving, you're here, you're a player, you're always there, you're doing best practices, you're aligning yourself with the bank's momentum, you're expertly accumulating your inventory, you understand why to get rid of it. You understand when your customer shows up that instead of being in pleasure and wondering how high is it going to go, how high will Bitcoin keep going, your customers are here. If you want to get rid of this stuff, you want to get rid of this inventory you've been buying, your customers are in your store. Give it to them. And then wait for the cycle to reset. You are trading cycles. And if the cycle is not set up, you don't have a trade because you don't have a reliable way to exit. All the people that are accumulating their Bitcoin right now, when do they get out? When do they have a reliable time to exit? And you know what? They don't. They ride it back down into the correction. Then it becomes a long-term hold. And then they're just doing a Warren Buffett strategy, which is okay. It's okay. But most of them get in because they thought they were going to trade it. Right? So, I mean to yell at you guys, but this is critical because this is our first webinar of this year. And as you guys know, the message that I've been saying is getting more and more to this point. If I had it my way, I would make all of you guys not be able to trade lower time frames. Why? Because the less long-term money is available on those time frames. Unless you have a market making algorithm, why mess with it? Okay. There's a few people in here, a handful, that are expert scalpers, and they get better and better. But their entire lives are around them being present for those key moments. Most of you don't have that luxury. It's fine. It's fine. They will be able to knock down these expert scalpers that love the craft, love getting up early or whatever, early in the States. They love being there at their desk and trading for those 3, 4, 5 hours and doing their thing. They love it. That's great. Most of you guys got other jobs, you got other obligations, you got other stuff going on. You can do what you want. But there is just the same, if not more, progress available to you on the higher time frames. I'm talking 30-minute, hour, 4-hour entry time frames, as there is on the lower time frames. Because when you're trading on the higher time frames, you will naturally put yourself in line for those big 30, 40 pip runs that you see on the 5-minute. You'll just be in. The actual difference, though, is that you'll actually have a much higher chance of capturing the whole move than someone trying to jump in and out on a 5-minute. So unless you are prepared to be an expert scalper, and dedicate your life to that, which is nothing wrong with that, then you'll notice that if you move up to the higher time frames, you will and get more patience and still do the good, use the fundamental rules I'm talking about, you have a much higher chance of looking back on January 2nd, 2026 and being like, I didn't blow an account and I'm up. Now, the other thing to that, what I said was that the banks are doing it with other people's money. I know that it's not perfect, and I know there are risks. There's risks even with our prop firm partners with Prop Account LLC. If you guys haven't seen, I did an interview with Justin. He's a pretty stand-up guy. From every interaction I've had with him. Okay. We simply are a partner with them and we pass on those services to you and kind of help mediate it in between. But ultimately, you guys are getting the evaluations, all that from them, and they do real funding. So Justin it's not a fake money account. The program we're in, it is a real funded account. That's why they're a little more expensive. But in my opinion, yes, there are still some risks. Things could happen with regulation, but they are very forward thinking. Justin was originally a litigator in this space. He understands it. That's why he's set up the business to be pretty regulation proof. So I think that it's the least risky prop funding spot you could be in. Okay. The fact that you guys have that, in my opinion, again, you could do whatever you want, but the prop funding does give you the ability to raise capital, essentially the same as the banks. If you are looking to purely make, let's say that you need to make $5,000 or $10,000 a month to facilitate your income, you have a much higher probability of getting to that very stably and very safely with a $250,000 or $500,000 account versus all you have is, let's say, $2,000, $3,000, $4,000, $5,000, and you're like, I can't even afford to put this in there right now. So you're going to be trading on scared money, and I need to double it this month. If I don't double it by the end of 30 days, I can't even, you have that much pressure. Why use your money? Again, I think everyone should take the time to think through this. I do not care about selling prop evaluations. Okay. There is, believe it or not very much money in those for us. Okay. It's almost a hassle. It is a hassle. I'll just put it that way. But I think it's the safest place to work on getting assets under management and to set up an infrastructure for yourself that is similar to what the banks are doing without you having to go get investors. I mean, the prop firm is essentially investing in you. So why risk your money? Why do it? Because if you can get 500,000 and you could get one of each evaluation. So you could have a 500, you could have a 250, you could have 100, you could have a 50. And there are ways to link them all together so you could mirror trade between accounts. But you could raise your capital by doing that. And you, at the end of the day, you, as long as you follow the rules set by prop account, you're good. Like they're not going to say anything about it. You just simply need to follow their rules. Okay. And as long as you do that, then you keep that money. And with that money, you could also set up your own infrastructure. You could set up your own, you know, $100,000, $250,000, $500,000 account. And then you're not 100% reliant on that anymore. But the key that you're doing, everything that we're talking here, we've talked about the methodology. In my opinion, the only sound way to trade is understanding the role of a trader and how to be a good trader. And I just explained that to you. I just explained with 100% logic, not just like trade off this line when it hits this line, buy when it hits this line, sell, support, resistance, blah 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 blah. I told you exactly the emotions that are driving the market and who's doing what and how to get a good read on that so that you can insert yourself in the middle expertly. That's done. The rest of this is money management and getting more to trade with, because the bigger pile that you have to trade with, the less risk you have to take to do what? To get what you actually want, which is probably some free financial freedom from whatever else you got going on, supplementing retirement, whatever it is. Your question is, what is the safest, most sure way to get that result? And I don't think there's a better way to do it than getting other people to invest in you without the hassle of having to have investors open a hedge fund or whatever. You essentially can provide yourself with that same infrastructure. And then when you can get, let's say, $500,000 account, you still trade it small. Because you could, if you're smart, you could probably take $5,000 a month out of 500K account, you know, particularly if you build it up a little bit, but you could take that $3,000 to $5,000 out of that account forever. You've actually achieved that result of filling that shortfall. That is my goal for you guys for 2025. Don't be another dead body that is in this business. Stop. Stop. There's no reason. You have everything here that you need to scale up. You have an indicator set that is not going to change on you. What I said today will be valid tomorrow. It'll be valid as long as these things are traded by humans and the robots that are running them are programmed by humans. This will hold true. So you have everything that you need here. It is just a matter of you guys coming to the terms of this is a realities. And sometimes when I say that, people are like, well, I don't really like it anymore then. If I can't do the big, if I can't have the big gamble, if I can't have that insane amount, if I can't make 300% a month, why even do it? Maybe, yeah, maybe you need to ask yourself that. I don't blame you. But typically, I think what a lot of people end up doing is they come to grips with this is they're like, you know, maybe I don't want to be the day trader I thought that I wanted to be. But I am cool trading a 4-hour chart. I like this, you know, building off to the side and doing it under these principles. And it takes much more of a side business seat in their life, which is cool. And you could specialize in one pair, run the 4-hour chart, look at the daily, the weekly trends, and understand fair market value and position yourself, and you could do great. You're not taking a huge amount of trades throughout the year, but you're definitely up. And you compound that over the next 5 years. And if you want to go faster, raise money. Don't try to give yourself a pay raise with your lot size on your small account. Give yourself a pay raise by getting more money under management and then lot down some more. Why? So you can keep the money. Guarantee yourself that you can keep doing it forever. That's it, man. That's the secret. And nobody wants to do it. Nobody, because it's just simply not the fun they had in mind. But I'm hoping that a lot of you guys are different. And that's my message. It is hard to do. It is not easy. It's simple, but it's not easy. But if we can get a good amount of you guys to understand the things that I've said here, understand how to survive and build a platform of foundational confidence, if we can get that for you guys, then the ATS success rate would be insane. Insane. We're talking the rest of the industry has like 90, 95%, are break even basically or losing, right? We're talking like if everybody did this, if everybody did this in this organization, no one would lose. Simply by you guys lotting down and forget the trend direction. If you just bought and sold above and below fair market value at a really low lot size, you'd stop losing money. You wouldn't make a ton because the probability ultimately is doing that in alignment with the higher time frame trend. That's where you get your big runs like what we're looking at right here. We want this stuff. At least we want the opportunity to be in for it, right? But if you simply just traded super small and understood where the value points were and close at value, you would watch your win rate skyrocket. We're talking literally everybody in this community making progress. It's just a matter of you being okay with what that actually means. And the moment that you are okay with that is the moment that you will start making progress. And I've asked people, I've said this many times on here, I've coached with people that have been trading 20 plus years, going through the high leverage, I got to be a day trader. It's almost kind of a gambling addiction, honestly. Um, they've been doing that because they're just chasing the holy grail. And I asked them, I'm like, what if you traded 1/10 the size that you trade right now? And you traded in the higher time frame macro direction, and that's all you did. Because these guys are smart. They've been watching price action for 20 years. They certainly know how the market flows. Everyone that watches a market long enough will start to understand price action and the feel of a candle and the time frames and all that. They got that. They simply can't give up on that dream that they were sold even so many years ago. They're still chasing that one thing. It has to be this outcome. And I'm like, what if you did that when you started? If you were cool with 2% a month, 3% a month, or something not 100, not 200. They would have been done a long time ago, a long, long time ago. So don't let it be you that goes 20 years and then is like, okay, I guess that guy, that 118 was right. No, just stop. You guys have a fresh year. This is a fresh year for you guys to quit the gambling stuff, lot down. We're going to have some big macro trends happening. Okay. The world's not getting any calmer. Okay. So you can count on that energy is coming into these markets. All you guys got to do over the next 12 monthly candles, okay? Start up there, look at the weekly, look at the dailies. Understand where the banks are going to make their money. Where are they showing those inefficiencies? Follow this stinking line right here. It's smarter than all of us are, smarter than our intuition, smarter than when we think things are going to bounce. Follow that line and accumulate your inventory expertly and do it at a low lot size. And watch how many of your trades just magically are always in the money. And that's it. Do that for 12 months. And if you're doing good at it and you're okay with this kind of slower pace way, then I'm not telling you what to do, but then maybe you want to look at getting an evaluation. You want to look at raising some money, just like the banks would. But don't do it. Don't do it unless you're prepared to follow, that you really are prepared to go at this at a slower pace, like I'm talking about. There's no reason to waste your money on evaluation either. I do not want you guys to lose money. I've seen so many horror stories in this business. And a lot of people Don't give two craps whether you keep money, lose money. I know firsthand the damage that these losses can do to not only your own psyche, but a family. I know. I lived it. Okay. Be safe. Set yourselves up to do this in a safe way so that you can see progress, something that you could be proud of, something that you can build your confidence on. Do that. This is the month to start.